Oh, perfect timing. We are now going to move on to Greg Sanders. He is going to talk to us. He is from National Benefit Services, and they administer our 401k plan. So if you ever need a withdrawal, a hardship withdrawal, or there's a question about something you want to change with your 401k as far as maybe beneficiaries or any of that kind of thing, Greg can help us with that. So Greg, are you still on with us?
I am.
Okay, great.
Okay, I'm going to share my screen here. My face might look a little funny. I'm using a virtual background because I'm currently, like most office personnel, working from home, and I'm in an unfinished basement. So I'd rather you see a virtual background than my unfinished basement. But I'm going to share my.
You could have chosen a beach in Hawaii or something.
I know, I was trying to be creative, but it didn't happen. You should be seeing my screen now.
Yes, we have it.
Perfect. Okay, so again, my name is Greg Sanders, and my role with regards to RMD management and the 401k plan is really helping you as a participant and RMD management as a sponsor stay in compliance with the different laws and regulations that the government has in place for 401k plans. And so, as Sarah mentioned, one of my main roles that you as a plan participant would interact with me or my team on would be whether or not you can do some sort of transaction, whatever it is, on a case-by-case basis. If there's questions in regards to can I take a distribution? Can I put this money type into the plan? Can I take a hardship request? If I retire, how is that going to affect my employer money that's currently in the plan? Just different things of that nature. And so my screen here, what you'll see is we will cover the general provisions of the plan. And then Art Arzola, who will present after me, will really go over kind of the market side of things. So as an employee, after 3 months of service and you've attained age 18, you can participate by putting your own dollars into the retirement plan from your paycheck. And that is a generous provision that a lot of plan sponsors nowadays, you see a longer wait period. Maybe they might make you wait 12 months instead of 3. So RMD is really giving you the ability to put your own dollars into the retirement plan and save for your future. Get that nest egg started now. RMD management does provide an employer match after you have worked for 12 months and met a 1,000-hour requirement. If you contribute to the plan, RMD management will make a match contribution equal to 30% of every dollar up to 10% of your pay. And so if you're putting in 10% of your own dollars, RMD will match 3% of that total. The plan is governed again by the IRS, and so you have the ability to put in a set limit, up to a set limit each year. For the 2020 plan year, it was $19,500 with an additional contribution if you're over the age of 50 for a total of $26,000. That will continue into 2021. There is a vesting schedule that is applicable to the employer contribution that goes into the plan. The longer you work there, the more of that belongs to you. Essentially, if you work for 1 year and quit, that 20% of what RMD management puts into the plan belongs to you as an employee if you were to leave. The remaining 80% would go back to the plan to be used at a later date. So the schedule you'll see there in the vesting schedule section continues to go up 20 to 40 to 60 to 80 to 100. So after your 5th year of employment, 100% of that money that they give to you in the form of a retirement contribution is yours, and you can do with anything anything that you choose at that point in time when you separate employment. Hardship withdrawals are, they do give you the ability as a participant in the plan, the IRS does, a very limited ability to take a distribution. The idea is that the money that you put into the retirement account is designed to be a nest egg for your future at time of retirement. And if there is money to be distributed from the plan prior to normal retirement age, there's very limited reasons. And again, the reason for that is to encourage you to save. You'll see the 6 allowable reasons for hardship distribution in the plan. The first is a down payment or purchase of a primary residence. The second is to prevent eviction or foreclosure on your primary residence. The third is to pay college tuition, room and board, fees for the next 12 months for you, your spouse, or your dependents. The fourth is to pay non-reimbursed tax deductible medical expenses. So this would be things that maybe are out-of-pocket expenses that are putting you in a taxable situation where you, I guess a hardship situation, not a taxable situation. You can use it to pay for catastrophic casualty or loss, as well as to pay for funeral expenses for your dependents, as well as any beneficiary. So spouse, children, if your parents were living with you or they were deemed your dependent, you could use that to cover a funeral expense if needed. In-service withdrawals, meaning if you're still employed with RMD Management, you cannot take distribution outside of those 6 reasons just mentioned unless you're over the age of 59 and a half. If you separate service from RMD Management, you do have the ability to take a distribution. That distribution does become taxable income to you in the year that you take that distribution. The federal withholding mandatory upfront is 20%, and you do have the option to have state taxes withheld. The enrollment process is pretty simple. If you're not enrolled, I would encourage you to get enrolled and begin contributing to the retirement plan. Help yourself save for the future. Take advantage of the market as it's been performing. And if there's questions, you can reach out to myself or to Sarah or to Art, who you will hear from next. I think that's all I have, unless there's specific questions.
I have not seen any questions come in on the 401k.
Okay.
I do know that earlier in the year, we had a question, someone had heard about a withdrawal because of COVID. I think I spoke with you about that, and our plan does not include that provision. Is that correct?
Correct. At the present time, it does not meet those provisions. However, if there is a unique situation, reach out to Sarah and to Robert, and we can have that discussion.
Okay, thanks, Greg.
Yeah.
Art. Oh, I see Art. Here you are. Art's coming clear from Texas, zooming right in.
You like my fake screen behind me? My looks kind of fancy, but it's pretty dark outside, so it looks nothing like that. Let me get my presentation uploaded real quick here, and get this moved here. And away we go. Okay, again, guys, my name's Art Arzola. I work with Enterprise Retirement Solutions. We're a group within Zions Bancorp. And our role is to assist you all with the investment options, talk a little bit about how your 401k has been performing. So if you were to call, let's say, John Hancock, who's the record keeper of your plan, and you had individual questions, they can't help you with the investment part of it. They're going to refer you back to us. I have access to look at their accounts. They give me the rights to do that. So if you guys have any questions on that sheet that Greg was showing you guys just a minute ago, on the bottom right corner, our information, and I'll pop it up at the screen at the end of the presentation here. That's how you reach out to myself. You see my email address is listed on the screen. during this time of COVID, I've been doing most of my meetings virtually, and that means one-on-ones as well. So if you guys have individual questions, you want to set up a time to meet with me over 30, 40 minutes or whatever, just either call me, send me an email, and we'll set aside some time, and I'll send you a Teams invite, and we can meet that way. And that's probably the easiest way to go about it. I think they've gone really, really well. So let's kind of, again, as I mentioned, there's a summary of plan features, and on the bottom, if you have that sheet that Sarah had sent out, under miscellaneous, you'll see the website for John Hancock. If you haven't gone onto the site and logged into your account, you'll notice there's a contract number listed there. It's 15961. So they may ask for that information from you when you log in. But I will say this, that the John Hancock has kind of revamped their website recently. So before it used to be JH Pensions. So if you went to jhpensions.com, it's going to click you over to myplan.johnhancock.com. So that it's the same site, but it'll kick you on over there if you haven't logged in before. My number's on the bottom right corner there, the 800-324-6705. And then if you need to call John Hancock, maybe reset your password and so forth, you see their number listed there as well, 1-800-395-1113. I do want to talk about the investment options and about performance. Just as a reminder, wherever you invest your money, if it's, especially when you're talking about 401ks or IRAs, there's only 3 places you can put your money. You can put your money in cash instruments, which are nothing more than short-term loans. When we talk about cash, we're generally referring to things like money market accounts, savings type vehicles, low risk, low return type investments. So you guys have a couple of cash options inside your 401k. Then if you look at those accounts, especially over the last 10 years, and you see what they yield you, 1-2%, you might sit there and say, well, that's just not enough. I need to make more on my money. So the next step up the ladder is going into the bond market. And bonds work the same way. You lend money to governments or corporations and they pay you back principal and interest. The question is, who do you lend your money to? If you lend it to the government, the yield is going to be a little bit less. If you lend it out to corporations, it might be a little bit higher, but the risk is higher because you don't know if these companies can repay you that debt. So you kind of have to study the bonds that you're lending your money to, or who's going to pay you that principal and interest back. Now, everything that I've talked about so far, whether it's cash or bonds or stocks, and I'm going to talk about just a bit, all your options that you have in your 401k are mutual funds. So they're baskets of cash instruments, they're baskets of bond instruments. And then finally, you're going to have a bunch of stock funds in there. And again, when you look at a fund, it's a basket of typically a couple of hundred stocks or a couple of hundred bonds, where either a manager or a team's buying it. Now, if you go into the stock realm of things, the reason you're going into stocks is for growth. You're trying to make money over a longer period of time, but you understand there's going to be fluctuations. There's no guarantees. You buy a stock today or stocks today, they could go up in value, they could go down in value. So we can't make you guarantees. What I can do is tell you that over time, the performance on stocks, and when I use a marker for performance, I always talk about the S&P 500, which is the basket of your 500 largest stocks on the exchange. And when I look at that performance, it has averaged a little over 10% a year. If you go back to the mid 1920s, I can tell you that stocks average a little over 10. Now, those are your Fortune 500 type companies, your biggest, strongest companies out there. Smaller stocks, mid-sized companies, international stocks perform differently. They're more aggressive. Sometimes they do better, sometimes they do worse. But when people generally refer to stocks, they're usually talking about your Amazons, your Apples, your Googles of the world. Now, when you build a portfolio, if you're sitting here and you're saying, well, I've got to make decisions now, there's different ways we can do this in a 401k. My job is really to assist you if you want to build it yourself. And I'm here to make sure that you're not making mistakes. My role, the role I'm in, even though I'm a financial advisor, is not supposed to tell you exactly where to put your money, but I'm going to kick you in the right direction. And that's my role, is to make sure that if I see something odd or see something strange, I'm going to bring it up to you and say, I might want to rethink what you're doing there. But again, for a lot of folks, they just don't want to get bogged down with those decisions. They know they need to save for retirement, and Social Security is probably not going to be enough. So I need to set some money aside on top of that. For most folks, especially in 401ks, you have what's known as target date funds. Now, in your plan, the target date funds that are used are from Vanguard. And Vanguard, the advantage of using Vanguard is they're very inexpensive from a participant standpoint. Vanguard uses averages. They use what we refer to as indexes, like the S&P 500 that I just referenced. But it's really simple. If you don't want to pick your funds, all you do is you look to the right where it says year of birth, and you say, hey, you know what? I was born between 1983 to 1987. And if that's the case, your fund is the 2050 fund. And you let Vanguard decide how much goes into stocks and how much goes into bonds. And then they're going to modify that portfolio the closer you get to that target. Now, if you notice on the right, it says default fund. If you ask for a packet and you say, hey, I want to get into this 401k at the start of the year, and you enroll, but you don't want to make an investment decision, or you forget to make an investment decision, they're going to default you into one of these target date funds based on your date of birth. That doesn't mean you're stuck in there. If you want to change it, all you have to do is log in and make those changes. So you have the flexibility of doing that, but it's done through John Hancock because they're the record keeper. When money comes out of your check to participate, they send it to John Hancock, and then you're in control. You decide how it gets invested. I personally think that these target date type funds are sufficient for most participants that don't want to sit there and kind of track everything. I know that, I'm going to show you some slides in a bit about historical performance after elections and that, just because it's timely, and I think it's something for you guys to see. But at the end of the day, when you put money into a 401k, you have to think long-term for most of us. If you're going to be working for another 10, 15, 20 years, that's a long time frame. And you can't get caught up in the day-to-day noise that's going on in the market, specifically over the last year. Because I'm going to show you some numbers right now for performance since I last spoke to you all. And you're going to say, well, things aren't that bad. And it just depends on when you look at things. But I think a target date fund's just perfect for most folks. Let me show you how some of these work. If you're in their first one, which is called the income fund, that's geared for somebody that retired at least 7 years ago. And the primary objective of that fund is basically income. And what's income? Bonds. Bonds and money market or cash, because that's what they provide. The secondary and really secondary objective here is growth. And that's what the stock percentage is, only 30% in this portfolio. So it's low to moderate risk. But then again, if I'm talking to somebody who's 72, 73 years of age, they shouldn't have 80, 90% of their money in stocks. That shouldn't be their objective unless they're just naturally aggressive with their money. But most folks at that point in their life are very conservative with their money. So this would fit somebody like that. But again, this is if you're in a target date income fund 7 years past retirement. If I look at something like a 2020, somebody that's retiring this year, if you looked at that portfolio, Vanguard has about 50% of it put into stock funds and 50% into bonds and cash. So it's becoming more, it's already at the 50-50 point stocks to bonds, kind of a split objective, part income from bonds, part growth of capital, but it's never going to have more than 50% of the money in stocks at this point. Going forward, it'll always have less than 50% over the next 5-10 years. And within 7 years, so in 2027, this portfolio is going to have 70% bonds in cash and 30% stocks, and it's going to merge into that income fund. If I look a little further out, if I looked at the 2040, well, the 2040 is about 3/4 of the money in stocks, because again, this person has 20 years to go. So they're sitting there, Vanguard's managing the money saying, well, this guy's got this, this individual has 20 years. We're going to be more aggressive with them because we can withstand the fluctuations of the market. So the objective here is more growth, higher levels of risk. And it's if you looked at a 2060 or 2065 fund, those things are 90% stocks because those people have to work 40 years. So that the whole, thought process is if you have a long time frame, accumulate stocks. But as you close in on retirement, you start playing defense. You start get into that preservation mode. And if you're in a target date fund, they're doing it for you. And for a lot of folks, if you look at here again, I'm going to pop up that sheet, and I think Sarah had sent these out to you guys. You see the target date funds at the very top, and I just want to point you to the year return because this is since September of 30th of 2019 to 2020, and I want to look at, let's say, the 2065 fund toward the bottom of that first grouping, and you can see it averaged 10.11%, and that's kind of in line with what I talked about how the S&P has done over the last 90 plus years at this point. So it's not perfect, but it kind of gives you an idea. So despite as crazy as it was in that second quarter of the year, the market actually has held up okay. But then below those target date funds at the very top, we have your individual selections. So you've got a short-term federal money market and a money market fund. So those are your cash instruments. In income, those are your 3 bond funds. You've got a Wells Fargo, a total bond market index, a PIMCO income fund. So you've got 3 different types of funds to pick from in the bond category. If somebody says, well, I want a little bit of both stocks and bonds, but I like a manager to kind of play both sides of the fence, we give you a balanced fund where that manager can have anywhere from 50 to 70% of the portfolio in stocks. And then that fund actually did pretty well over the 1 year, 9.4. And then right below that, in orange and red, those are your stock funds. And the further you go down, the more aggressive it's becoming. So down toward the bottom, when you get to the Euro Pacific Growth by American funds or the Columbia Overseas funds, those are your more aggressive ones. But you can see it when you look at those 1 year returns. I mean, the one that just sticks out of me when I looked at this sheet yesterday, you see that Wellington Mid Cap Growth Fund, it was up 52%. That doesn't mean it's going to go up 52% again. It just says over this 12-month period, it skyrocketed. And anything with the word growth tied to it, and you see under Morningstar category, whether it's large growth like the Blue Chip Growth Fund or the mid growth that I just talked about, or the small growth, the Vanguard Explorer, those funds have done really well. And the reason is tech stocks have done, and I'm going to show you some data in just a bit to back that up. So anything growth related, tech oriented has just been on fire, even despite the pandemic where it had a dip, but it's done extremely well. Just again, as I mentioned, you have a couple in the cash category there. There's your 3 bond funds, there's your balanced. And then when we get over to stocks, you've got value on the left side, Vanguard, the T. Rowe Price, and the Vanguard Small Cap Value Fund. And when you see the word value, think about bank stocks, insurance companies, nothing flashy. If you see the word growth on the right side, those are going to be your tech stocks, your pharmaceutical companies. You're going to pay more for those stocks, but you want movement out of that. And a blend right down in the middle is a combination. And we have indexes in each one of those categories, whether it's the 500 index, which again, as I mentioned, the 500 largest companies, mid caps, which are smaller companies, $2 to $10 billion size companies, and then small cap from a TIAA CREF fund. It's small companies under 2 billion. One of the things to note, it won't pop up on it might pop up on my screen next, but small company stock funds have got hit a little harder because of the companies that were well capitalized have seemed to do really well. Smaller stocks who tend to borrow more money have been hurt a little bit more during this pandemic period of time. And then on the international side, you've got 4 selections there. A Columbia fund, one from Fidelity, American Funds Euro Pacific Growth Fund, and a John Hancock International Growth. One of the things in my role is if you're building this yourself and we have this discussion and I pull you up and I see what you're in, if I see this international part, I like participants to be at around no more than 20% of their money on the international side. So I like to kind of dig into that because sometimes I'll see people that really go overboard on that. And if you're not paying attention to this, you can get burned pretty easily because these tend to be more aggressive type funds. So, again, this is the role that I play for you guys, and you can access me at any point to have those discussions. I did want to show you these final screens here. I mentioned the 1 year performance, and cash is on the bottom left, that 3-month T-bill. And so that gives you an idea of what money market funds. Now, since this pandemic started, the Federal Reserve lowered rates tremendously. So this number is going to start coming down over the next quarters, but it was 1.14 over the 12-month period. A good indicator of bonds is the Barclays Bar Cap Index. And that's about a 7% yield. So that's what bonds kind of paid out. Good quality bonds. The Dow is a marker of only 30 stocks. So rather than use a smaller gauge, we like to use the S&P 500 because you're more diverse. You got a better indicator of how the economy is doing. So as you can see, the S&P over that 1 year period did about 15%. Again, historically about 10 over the 1 year since September to September, 15. So that's a good return. However, small company stocks, which is the Russell 2000 small companies, only did 0.39. So the performance is vastly different from large Fortune 500s to really, really small companies. NASDAQ has a lot of tech in it, and you can see how tremendous it has performed over that 1 year. That explains, that mid cap fund that's up, 52, because it has a lot of those tech oriented options. EFA and the MSCI EFA are international stocks, only up about 0.5%. So it's treading water positive for that year period. And then you have commodities at the very end there. A lot of that's tied to oil and energy. It was down about 8% for that year. So that kind of gives you an idea, a gist of where the market's done. I will show you one other thing in sector performance over that 1 year. Tech, as I mentioned, without a doubt, leading the market at 47%. Cyclical stocks, homes, car purchases up 36%, healthcare at 23%. And as I mentioned, energy at the very bottom, down 44%. So when you look at a fund and you see if it's heavily structured toward energy or maybe financial services, you kind of get a feeling those are value-oriented areas that they probably didn't do as well over that 12 months. If your fund had a lot of tech in it, it probably did really, really well. I did want to finish up on these last slides because the election, that was held yesterday. We're still kind of, things are in limbo, but I like to show this slide that came from one of our vendors so that you guys can kind of get a gauge as to performance. And this is, as the orange bar charts are stocks, the yellow bar charts are bonds performance. And if a new president's elected, the performance in the subsequent year tends to favor stocks about 9% to 6.7 in terms of bonds. And all presidential years over times, from start to finish, from January to December, up about 11% for stocks, about 5.5% performance for bonds. And if the incumbent president tends to win, the performance has been a little bit more in favor of stocks at 13%. I think whenever you look at this information and you hear about stock performance, and I think we had it 4 years ago when the market dropped immediately and then bounced back quickly, it's adjustment of portfolio. These fund managers they like to see stability. I was on a call this morning, and they want certainty. They want to understand, if there is a change in presidency, what are going to be the objectives? When they hire a treasury secretary, whoever they may hire, how's that going to kind of lead going forward? And then this is, I think, probably the best slide to finish up on here. Whether the same party's in charge, and since 26, that's happened 47 years of the time, and through 2019, divided government's 47. So it looks like we're going to have divided government again. It looks pretty secure on that. And if it's divided government, it's always been kind of even after 1 to 3 year cycle, 10.8, 10.9% overall return. If the same party tended to win, so if let's say the one party wins the House, the Senate, and President, the first year it tends to do pretty well at 13% plus, but after that it trails off and actually underperforms a little bit. So I think that gives you kind of an idea. I think people overthink it. As I mentioned, fund managers have a tendency to adjust their portfolios. As I mentioned, finishing up, if you need to reach out to John Hancock, their website now is still jhpensions.com, but I think if you update it to myplan.johnhancock.com, their contract number, if they ask for it, is 15961 for your plan specific. And if you need to reach out to myself, I can be reached at the hotline there. Again, my name is Art, A-R-T. I answer any of the calls that come through. And if you want to set up a time, I'll be glad to do that with you guys. Sarah, do I have any questions that kind of popped up during my presentation, or does anybody want to ask questions?
We had one question come up. I don't know if you want to take it, or Greg, if Greg's still on, about eligibility when a new employee is able to enroll in the plan.
Greg, do you want to jump on that?
Yep. So as a new employee, once you have completed 3 months of service, meaning you've been employed for 3 months, and you have attained age 18, you can complete the enrollment paperwork or the enrollment process. The contributions or the withholdings from your paycheck won't start until the first of the next quarter. And so after you've met that 3-month requirement and you are age 18, go ahead and let Sarah know. She'll get you pointed in the right direction as far as enrollment goes. And then again, the first of the next quarter, you will see those withholdings from your paycheck.
And we actually have an auto enroll feature. So Am I
Yep.
still on? Okay.
Yep.
I was running out of battery. We have an auto enroll feature. So if you don't do anything, you'll be automatically enrolled at 3%. But if you want to do something other than that, or invest in some other funds and talk to Art about options available to you, then definitely that's available to you.
I might add that if somebody's auto enrolled, they're auto enrolled on a pre-tax basis. The plan does allow for Roth contributions. So if somebody would rather do an after-tax contribution where their money grows tax-free, that is an option, but they'd have to actually physically go change that by notifying it on the enrollment by going to John Hancock and making that change.
Right. And informing us so that we take it out.
Correct.
So, okay.
Sarah, I just wanted to point out one other thing. I know Art, you had mentioned giving John Hancock a call if they have questions. You're welcome to use them as a resource. John Hancock has recently started doing some additional fraud protection measures on participant accounts. And so when you call in, if you choose to call into the John Hancock number, you will need the contract number that Art provided, 15961. But they will also ask you to verify your full name as it's spelled on the account, possibly your full social. And then also they've been using the mailing address that's on your account as well. If there's no mailing address tied to your account, then they won't allow you to speak with them. And so if there are concerns or questions, if you're concerned that maybe your address on file is not correct, get with Sarah or myself. We can get the John Hancock system updated so that you don't have issues when you call in.
Great. Thank you for giving us that information. And Art, thanks for that education. That's always good for us to be aware of what we're looking at and what we're looking for.